Okay, good morning all. I think in the interest of time, as participants are actually joining, we can kick off the session. Yes, it gives me great pleasure to welcome you all to this morning's Sanlam Umbrella Fund Investment Feedback webinar. I trust you're all looking forward to this punchy and impactful section, where we'll unpack the trends affecting global and local economic climate, especially with local elections coming up next week. I think there's some interesting decisions being made by government, like NHI. Something that's still remaining a massive concern is the increase in our unemployment rates, which will be further discussed by our panel. And I just want to welcome you and welcome our esteemed speakers this morning as well. So taking us through this morning, will be Sally Tsiye, who's the head of our investment strategy at Sanlam Corporate Investments. We have Arthur Camp joining us as our chief economist at Sanlam Specialized Finance, as well as we have Carmen Nell, who's the head of multi-asset at Terrabin Capital. And then thereafter, we'll kick off and, what are these economic and global climate conditions actually affecting in terms of investment performance, which will be covered by Paul Wilson, who is our Chief Investment Officer at Sanlam Investments Multi-Manager, together with Danny van Zyl, who's the head of our Smooth Bonus Center of Excellence. And then just concluding by our Managing Executive of Sanlam Umbrella Solutions, which is Nzwananai Shuniwa. Okay, thank you very much. And enjoy the session, and I'll hand over to Sally. Good morning, Sally.
Morning, Sumo. Sorry, I was just looking for my unmute button. Good morning, everyone. So if we think about the purpose of today's feedback is to give you the investment feedback in terms of the portfolio returns that members have earned, but those are affected by what's happening in investment markets. And investment markets are in turn affected by what's happening in the economy and also other macro events. And today, just to give you a backdrop of what is affecting those investment markets, I am joined by two of the top economists in the country. So Carmen Nell, who's head of multi-asset at Terrabin Capital, and also Arthur Kemp, who's chief economist at Sanlam Investment Group. So I'll be asking them a few questions just to try and help us think about what the future holds for us. Carmen and Arthur, welcome.
Thank you, Solly. Hi, Carmen. Hello, everyone.
Thanks, Solly. Hi, everyone.
All right. Just to kick off the discussion, looking at what has been topical recently, we have seen inflation creeping up and central bankers responding with raising interest rates. I think it would be worthwhile just to kick off the discussion by helping us think about where are we in the cycle. The interest rates are currently high. What are we likely to see in the future? Maybe I can start with Carmen, and then Arthur, please feel free to add to that question.
Yes, I think it's quite difficult to say where we are in the cycle, because I think there's no longer this idea of a synchronized global cycle. Certainly in terms of growth, you've seen countries going at different paces. So US is now slowing down while we're potentially looking at a recovery in Europe, UK, as well as potentially China. And that means that there could then be more disparate inflation outlooks. If we think about it, though, broadly, as inflation has moderated, certainly in SA, again, today we had a downside surprise in the April CPI inflation release, which probably means we are now past peak interest rates locally. And one could argue that the SARB maybe should already have eased rates. And I think part of the reason they haven't is that they are potentially waiting for the Fed. So I would say we passed peak rates, and we should now be looking at a cutting cycle in SA. And the question is whether the SARB is able to cut before the Federal Reserve in the US, or whether they'll wait and only ease rates after. So I don't know if Arthur has a particularly strong view on that.
Carmen, I agree fully with Carmen there. Can I jump in, Solly?
Yes, happy.
So Carmen, I agree fully with that. I think the key point Carmen makes there is, amongst a few key points, is that inflation has peaked. So if we look at South Africa in 2022, inflation peaked at 7.8% in July that year. And it's been on a downward trend since then. And if you have any confidence in your inflation forecast over the medium term, most of it seems these inflation forecasts are trending to around 4.5%, which is the midpoint of the inflation target range, which is what the SARB targets. So I think it's a matter of when rather than if interest rates come down. Carmen did mention global conditions, and the Fed is, of course, important in this. I like the governor's recent comments that we watch the Fed, but we don't follow them. It would, of course, I think, make it easier if the Fed were to start cutting rates, because we do benchmark off the US risk-free interest rate. But if you look at that US Fed funds rate, the range at the moment, 5.25 to 5.5%, even if inflation's a bit sticky, let's say you can't easily get it below 2.5, it's a bit of a struggle to get it below that level. Even then, you're looking at a fairly significantly high real interest rate in the US, which is quite restrictive. And therefore, I think it's reasonable to assume that the Fed does start a significant interest rate cutting cycle over the next year, which should hopefully make it easier for us as well then to follow suit. So, yeah, I think it's a matter of when rather than if. Things could go wrong, but I think that will come out in the discussion that we had this morning.
So, I mean, looking at where the interest rates are at the moment, we are accustomed to, high interest rates being associated with some level of slowdown in the economy, and we have seen the economies being a bit resilient. Does this mean that once we start seeing interest rate cuts, it's going to be the only way is up from here, or, how do we think about these?
Yeah, I suppose the US is unique in that regard, in that that's been the economy that has been very resilient. And part of that could arguably be that monetary and fiscal policy was excessively supportive over the last 2 years. So interest rates there may be warranted to be elevated. I think if we bring it back to SA, our economy now post the COVID sort of rebound, and if you look at the sort of 5 years leading up to COVID, I mean, the economy is effectively stagnated, right? I mean, we were very excited if we could grow above 1%. So I think definitely interest rates here are high. I think if we get easing in the US, I think that'll cause a risk-on rally. So that's maybe more of a short-term story in terms of bond yields falling, equity markets rising. I think definitely SA asset prices will take part in that rally. But I think in SA, the bigger story really is reform rather than modest interest rate cuts. So yes, interest rate cuts, the way I look at it is that it will bring relief to the consumer. I don't think necessarily the modest cuts that certainly the SARB is expecting to put through down the line is really going to massively boost the consumer. So the consumer is under a lot of pressure and it really needs the relief from lower rates, but I don't know if it's going to be enough in isolation to cause sort of a sustained growth re-rating. I think that's really the reform story that comes into play.
Thanks, Carmen, for also bringing it home. I just want to ask Arthur to expand a bit more on South Africa, that there has been, I guess we hear about specific factors affecting the economy, load shedding, infrastructure. Arthur, can you please maybe summarize that for us? But I think more importantly, is there a glimpse of hope? Is there light at the end of the tunnel when you look at, growth prospects in the South African economy?
Solly, yes. So if we look at the simplest way to put it, I think was like the Reserve Bank in its recent monetary policy statement, where it said that load shedding had subtracted 1.5% from GDP last year. So we grew at 0.6. If you add 1.5, that's quite a substantial difference. And if you look at the reform program, the issue about the reform program for me has always been it was going to take a long time to put the required legislation in place around the transport sector, electricity sector, and also the telecommunications and elsewhere. To put that in place was always going to take a long period of time. And now we're starting to see this legislation actually starting to fall into place. Bills are being signed. We know, for example, in transport, this is opening the way to corporatization of the ports. We know that it's opening access to freight rail for the private sector. In terms of telecommunications, those reforms are quite advanced, and that should add significantly to growth. And we know in electricity, the legislation that has been changed has enabled a lot of private sector investment to come on stream. And of course, there's more to be done, but we're starting to reach the phase now where we're moving away from legislation that needed to be put in place to implementation thereof. The key aspect of this is that there is still risk around. We understand that. But in terms of prospective returns, if investors now feel that those prospective returns are high enough given the perceived risks, then that should attract capital to invest in these sectors. And that's the critical thing. We have a low savings rate in South Africa. We can't run a large current account deficit. That means we can't invest strongly unless we get sufficient capital inflows to cover that. So, a lift in growth does assume that those capital inflows do come to the fore. But I think with the opportunity here to significantly improve aspects of infrastructure and the potential returns on that hopefully we do attract that capital and grow more firmly. I think it's quite reasonable to expect that this should improve growth quite significantly over the next few years. At this point, though, I don't think growth is going to be strong enough next year to sort of influence the SARB too much, in the sense that there's not much of an output gap expected. If the growth is about 1 to 1.5% next year, we're at the midpoint of the inflation target range. So at 8.25%, the repo rate's too high and should still come down in that environment. And as Carmen has said, lower interest rates can be supportive of markets, depending obviously on things that could go wrong. I don't know if there's time to get into that, but we can maybe leave that for a bit later.
Yeah. So I guess in line with, I want to say majority of the world, because we also hear that 2/3 of the world is heading to general elections this year. South Africa has its own elections. And I just want to latch on to what Arthur was talking about, painting some scenarios. I sense a glimpse of hope from you, Arthur. But just on the impact of upcoming elections, I know it's very difficult to predict what the outcome is. So we probably think of this as a scenarios. We don't have to concentrate too much on the scenarios. But Arthur, what do you think the impact of the elections would be, given what you've just, the picture that you've just painted?
Solly, I think it boils down to one thing, and that is, do we have a government formed after the election that continues with a reform program? And particularly within that, a key aspect for investors is fiscal policy and the sustainability of fiscal policy. We know that there are challenges on that front, not least of which over the medium to longer term is how to absorb the spending implied by the NHI bill. But it did seem for a while there as if it was analysts versus polls almost, with the polls coming in quite low on the ANC. And more recently, if you look at the Social Research Foundation daily tracker, it's showing that the ANC is becoming to show a bit more strongly, perhaps more in line with what numerous analysts had been thinking, in which case it remains very much, was always going to remain the bigger party, but didn't need too much or got enough of the percentage of the vote that it was fairly easy for it to put together a coalition if it needed to, of like-minded thinking parties to be able to continue with the reform program. So I think that is where we are. We've had a collapse in infrastructure. This has been talked to, ad nauseum around South Africa for a long period of time now. As I've indicated earlier, I think we are on the cusp of doing better and moving in the right direction. We do still need, I think under this president that we have at the moment, President Ramaphosa, I think he's been significant in driving the reform program. And if he remains in a position where he can continue to drive that reform program after the elections, which we think does look like a reasonable base case to work with, then at least we can start to generate firmer growth and hopefully over time grow fast enough to grow our way out of our issues, including our fiscal sustainability issue.
Can I jump in there? Take a slightly different tack. Well, I agree that things are looking more certain. So I think if you think about financial markets hate uncertainty, right? So with the polls having now come out and showing that it's more certain that the ANC will get sort of 45 to 47%, therefore have a coalition with smaller parties, and then you have the policy continuity and reform. The flip side to that is that as our democracy matures, obviously at some point we're going to have to become accustomed to coalition politics. And sort of there's that, call it sort of a messy J curve associated with coalition politics. And whether we do it now, we do it in 2029, it is still coming. I think what is crucial, and I think it does tie into the reform and maybe a bit on the corruption side, is that at least now with coalition politics in a proper manner, you actually have a broader opposition that has stronger maybe tools to keep the ruling party or to make them accountable. And that then is also important in terms of not just policy continuity, but the correct policies continuing. Because, right, the flip side is that you put bad policies in place and actually successfully implement them.
So, Carmen, I also want to ask you, I think you're painting a interesting picture that we, at some point, we have to be accustomed to coalition. And, you know, we are a new democracy. How do you think that's going to pan out? Just looking at how this played out in the municipalities, how are we going to ensure continuation of correct policies, as you put it?
Yeah, so what's interesting, there is a draft bill before Parliament that sort of is trying to put some legislative framework in place at the local government level to manage coalitions, right? So, and that's where we've had our first taste of coalitions. And obviously it's a learning curve, as I said, so it's not going to be done perfectly the first time round. And I think maybe that could be this time where some of the jitters come in around, you know, we have the elections and then they've got 2 weeks to form a government. And we're hoping that they can form a government quite quickly, that it is a reformist inclined government, as opposed to a populist government, certainly from a financial market perspective. And then as we now have learned some lessons at the local government level, we can apply them either provincial, where there'll be more coalitions. If you look at the stats around Gauteng, KwaZulu-Natal, as well as the Western Cape, whereas the other provinces do seem to be still a clean sweep for the ANC, and then ultimately at the national government level. So again, it's a learning curve. It's going to be a bit messy at times, so there will be ongoing volatility. So it's not to say that, you know, the perfect outcome next week, Wednesday, or when they announce results in 3 days time after that, will just cause a sustained rally, as I mentioned. But I agree with Arthur that sort of, it feels like the skew for SA asset prices, given how cheap they are despite the recent recovery, so cheap from a structural perspective, the skew is definitely to the upside rather than a massive sort of left-hand tail, you know, so we are coming off a low base and there is definitely re-rating prospects despite what will be some political volatility over the next sort of 10 to 15 years.
And then for investors that are in the market or looking to get into the market, I like how you said SA prices are cheap at the moment, Carmen. What do you think they should do?
No. Okay, so again, it depends on what your investment horizon is. But from a longer term perspective, if you do believe that the outcome will be a reformist inclined government, that structural change or reform will continue, even if it's at a slow pace, because Arthur highlighted why it is so difficult to get these things through, then there is massive upside. I mean, if you think about equities, you know, having traded at a persistent sort of 25 to 30% discount on a forward PE basis versus its long run history, as well as our EM peers, bond yields are screening very cheap. If you think about where our EM peers are trading. So part of that reform needs to filter into the fiscal consolidation. Again, Arthur highlighted that. So from a longer term perspective, there's a clear case to be made that you can have some home bias in your allocation. So I know all the rage of the past year has been to go offshore, offshore, offshore. But if you think about the valuations, particularly in DM and the US equity, there certainly is a case to be made to have some home bias. Obviously, next week is a key event risk, and we need to see the policy bias after that. But yeah, my skew in terms of SA asset prices is still to the upside.
Thanks, Carmen. Arthur, just maybe a bit of a left field question, but this is a recent development. Thoughts on NHI? Is this aligned with the reform? Is this the right thing to do?
I'll get to NHI in a second. I think it's a very important development. Just 2 points to make. I think it's important for investors to keep a strong eye on policy and what policy looks like. Although I think things are going to be improving, I don't think it's off to the races. And the very important thing there is to understand that South Africa needs to grow fast for a long period of time to get the unemployment rate down meaningfully. 2% growth isn't going to do too much to our unemployment rate. And the one thing that we need to keep an eye on consistently is fiscal sustainability in an environment like that, because you continuously do need to provide support to your population, and NHI is an example of that. And if fiscal policy proves to, has to be sustainable, if it's not sustainable in the long term, then you have to start thinking about how do you position yourself for long-term worse than expected inflation outcomes. So we do need the reforms, and we do need to move beyond just sort of the middle road scenario sketched on the slide towards the sort of high road scenario where we really do the full thing on economic reform, and we're quite a long way away from that. So and this is important because if the population, if there's no employment growth and the population is still growing and GDP per capita is declining, you have a problem. And we tend to measure health spending as a percentage of GDP, but it's not the most effective thing to do. That GDP is not going anywhere over a long period of time. And it's very clear that we need to do something about healthcare in South Africa, and certainly the 50 million people who have to rely on state healthcare. I think the general consensus is that they need a much better level of care. So now the thing about the bill, and this is a bit of a concern, is that it produces uncertainty for the private sector, because although it's reasonably clear in what it would like to do in terms of timeframes and in terms of exactly what NHI will cover, has not been clearly articulated yet. I think it's difficult to do that upfront for the government, but one needs significantly more clarity to figure out where we're going with this. Of course, the big thing for economists is to try and figure out what the total impact would be on, for example, the fiscus, what level of spending is going to be required to accommodate NHI. You can go back to the work done in 2011 by the Department of Health and get some idea of the type of spending that they envisaged back then, which was eventually, after a 14-year period, around about 250 billion rand per annum, but that was 2010 prices. So if you escalate that with health inflation over the subsequent decade and more, you get to quite big sizable numbers in terms of spending that's required. The other issue is of course, if you're going to be adding to demand, which you're quite clearly going to be doing here, you've got a given level of supply of health in South Africa, you're going to add substantially to demand. And so if you're at the same time trying to reduce pricing, because this is another important part of the bill, is that it indicates that the private sector spending is quite expensive, and so you need to try and reduce that pricing. Now, the problem is, if you don't expand supply sufficiently, you add a lot of demand and you try and reduce prices, you're going to end up with shortages and long queues. And I think that is the concern here, is that the private sector needs clarity in terms of what medical aid schemes are going to be allowed to provide, what the timeframes are here, and so that we can because in an uncertain environment, it's potentially so that the private sector may not be so clear on the investment that is required. So unfortunately, I think the uncertainty around this bill, the potentially high expenditure that wouldn't go along with it for government, and how that would be funded through taxes or otherwise, I think this is something that we're going to have to stay on top of, because it could make a significant difference to long-term fiscal sustainability. If so, of course, the question is, what does that mean for inflation? And ultimately then, what does that also then mean for asset prices more generally?
Yeah, so as we bring this session to conclusion, because it has been scheduled for about 20 minutes, maybe from each of you, what's the message that you want to leave the audience with, as retirement fund members and also as general participants in the economy? I can start with Carmen.
Yeah, sure. So as retirement fund members, obviously it means patience. Stick to your sort of philosophy. And when things feel really bad, that is not the time to bail out of markets. That's the time to bail in. So that would be the key message. So stick it out. Yes, things are volatile and uncertain, but it's never the end of the world. Yeah. So what was the other question about? The economy.
Just a general participant in the economy, yeah. Living in South Africa.
So look, it is, as I mentioned, it's been stagnating for a while. We had the blip, around the commodity price recovery post-COVID. But things are happening. If you just think about the size of, let's call it in inverted commas, the informal economy, if we can, get that included, more formalized, taxed, then, that may partly go to solving our fiscal issues. So I think on the ground, things may not be as bad as sort of headline or front page newspapers would suggest.
Thank you. Carmen, Arthur, what's your message?
Well, my message is I think we're going to feel significantly better, at least in the short term. I think that cyclically we are in an interest rate cutting cycle. Mentioned things could go wrong. One of them, keep an eye on, maybe it's more medium to longer term problem, US high debt levels. And what that will mean is makes the Fed's job a bit more difficult because ultimately you need high real interest rates to keep on your disinflation trajectory. But at the same time, those higher real interest rates feed back into ever rising, or at this point, significantly rising interest to revenue bill for the federal government. So there's conflicting objectives there, and that might influence to an extent how far the Fed does cut. In South Africa, we'll have to wait and see as well whether the drive towards potentially reducing the inflation target means that we also have a shallower rate cutting cycle. All of these things could happen. We'll keep an eye on them, but generally, I think overall interest rate cutting cycle, obviously that's very helpful. Longer term, eye on the election. Does the reform program continue? Sustainability of fiscal policy to get an idea of where we're going in the medium to longer term.
Thanks, Arthur and Carmen. I think this provides a useful backdrop to what Paul Wilson, the Chief Investment Officer at Sanlam Investments Multi-Manager, will be providing the investment performance. I'd like to thank both of you for the insights that you've given us today. I'll now hand over to Paul.
Thanks very much, Sally, Arthur, and Carmen. Thanks for the insights. I really appreciate it. So yeah, let's move over to the performance. I suppose the nub of the issue. Donnie and myself will take you through that. So yes, let's get going. Sorry, I seem to have skipped a slide. All right, so markets up until the end of April were actually fairly positive for the year to date, and in May that has continued. So the SA equity market had a bit of a weak start to the year in January and February, but came back strongly in March and April, and that's continued now. You can see over the 6-month period, if you look over here in this column, you can see how strong equity markets have been. 11% for the All Share Index, 20% for MSCI All Country Index, and over 1 year in longer terms, global equities have strongly outperformed local equities. And so it's really been, have you had enough offshore assets? Despite very attractive valuations on the local side, bond yields, as you kind of mentioned, because of the interest rate cycle, have continued to push up, which is why year to date you see nominal bonds and inflation-linked bonds actually delivering you a negative return on the local side. And similarly on the global, you can also see year to date how bond yields have pushed up. And that's really as a result of continued high inflation and expectations that interest rate cuts are being pushed out. At the start of the year for the US Fed, they priced in 6 interest rate cuts. Now they're looking like they're probably pricing in 2. So expectations of the market have changed a lot, and as a result, bond yields have continued to rise. But equity markets have done very well. And that's really off the back of the fact that it looks like the data is showing that GDPs globally and earnings from companies continue to grow despite the high interest rate environment. And I think that's important because whilst the interest rates are high, many consumers in the US in particular have locked in kind of their home loans. So they're not paying very high home loans. So they're not really feeling the impact of high interest rates. as quickly as what we have in South Africa as an example. So we don't really have the option to lock in our home loan for 30 years like they do in the US. So when interest rates go up in South Africa, we feel it a lot faster. Whereas in the US, they haven't really felt that impact yet. So hence equity markets have continued to rise. But overall, the last 1, 3, 5, and 10 years for global equities has been a very positive story. On the SA equity side, it's been a bit more muted, but we're starting to see some of that value come through. Whether or not the elections impact that remains to be seen, but I guess we'll get an answer to that next week or the week thereafter. All right, so if we move on to the default strategies, again, there are 4 trustee-approved defaults from a life staging perspective. You can choose one of those life staging portfolios, so Sanlam Life Stage Strategy, the Passive Life Stage Strategy, the Sanlam Blue Life Stage Strategy, and the Sanlam Wealth Creation Life Stage Strategy. The Life Stage Strategy, Sanlam Life Stage Strategy, is a strategic asset allocation portfolio. It's got a same strategic asset allocation as the Passive Life Stage Strategy, and then those two, one's just active and the other one's passive. The Blue Life Stage Strategy is managed with just Sanlam capabilities inside it. And then the Wealth Creation Life Stage Strategy is a peer benchmark portfolio. So when I show you the differences in performance later, you'll understand why something like Sanlam Wealth Creation performs differently to Sanlam Life Stage, because the one's trying to beat a strategic asset allocation and the other one's trying to beat a peer group. On the protection side, again, you've got a volatility protection strategy, a stable secure strategy, and a Sanlam stable strategy. Those are strategies that Donnie's going to give us feedback on later. So I'll give us some feedback on the general menu, as well as a bit more insight on the life stage strategies from the trustee approved default. I think what makes the Sanlam Umbrella Fund proposition really, really good from this point of view is that instead of switching you on your birthday at a very kind of inopportune time, because it happened in 2008, I saw it when I was doing asset consulting. There were members that were switched from at the low point in the market from very aggressive portfolios to very conservative portfolios. So I really like the fact that in the default strategy, in the life stage strategy within the Sanlam Umbrella Fund, they do 50 monthly switches to de-risk you from the accumulation phase to the capital protection phase. They do it over a 6-year period. So it's not as if one day you wake up and you have a lot less risk assets than what you did yesterday. And that then takes away the risk that market all of a sudden rallies very strongly and you out of it and you've taken all the downside. So I think it's a nice way of making sure that you take those de-risking over time, and that means you have less chance of getting de-risked at the wrong time. So if we look at the various strategies on the life stage side, the Sanlam accumulation portfolio, which is the life stage, here's its strategic asset allocation. Again, you can see this fund is trying to beat its strategic asset allocation. So the performances is quite close. Over a 1-year period, it's outperformed, and over 5 years, it's also outperformed. 10 years, it's slightly behind, and 3 years, it's basically tracked it. The passive has done what it needs to do in terms of tracking its index. The blue portfolio has lagged somewhat, you can see, across time periods, and has not really kept up with its peer group benchmark. And then the wealth creation portfolio has strongly outperformed its peer group benchmark over all time periods. So again, the wealth creation portfolio and the blue portfolio look to beat more peer group benchmark, where the enhanced balance tracker and the accumulation portfolio look to beat a strategic asset allocation. So you can see over the last 1 year, as an example, the Sanlam accumulation and the wealth creation portfolio are quite close, but they do that in very different ways. If we look relative to peers, how have things been going? So, I mean, you can see that over the last 12 months, the wealth creation and accumulation portfolio are actually outperforming the other large umbrella life stage strategies. And if you look over 3 and 5 years, the wealth creation strategy has outperformed all the other life stage strategies, where accumulation has been a little weaker. But again, not too bad. There are differences in the way that fees are reported and things. I think that's one thing just to note. So talk to someone about that, but some of these performances are gross of all fees and some of them are net of some fees. But in general, the Sanlam Wealth Creation portfolio is strongly outperforming on all time periods. And the accumulation fund, because it follows a strategic asset allocation, when that strategic asset allocation does well, as it has over the last year, it tends to do well. So it'll be guided very much by its strategic asset allocation. And so, for example, in a month like May, because it's got a very high exposure to SA assets and risk assets, I expect this portfolio to do quite well relative to some of the other funds, because SA equities have done well, whereas over the last 3 and 5 years, you saw SA equities have underperformed global equities quite significantly. And this fund has a lot of SA risk assets in it. So on the member choice portfolios, obviously the umbrella fund's got quite a lot, many in the moderate aggressive space, some in the moderate space, some in the conservative space, and only one option for cash. So if we just go through some of the performances on these, you'll see over the last 1, 3, and 5 years what's done well. Again, over the last 1 year, the default strategies in wealth creation and accumulation are right up there. And if you go down, you'll see some of the external managers. There's Alan Gray, Camisa, the Sanlam Living Planet Fund, which is very much an ESG and an environmentally focused fund. So it has a slightly different mandate. PSG, the Sharia option, Truffle, 91 SPW. Again, if we move over 5 years, Coronation have done well, Truffle have done well. There's the default Sanlam Wealth Creation strategy, SMM Select Balanced, which is a fund of balanced funds. The Sanlam Living Planet, which again, as I mentioned, is an environmentally focused strategy. It aims to get less than half of the carbon emissions of the basic indices. That's the idea of the fund. Alan Gray, SIM, and the SMM products, all the way down to SIM Balanced, which sits at the bottom. But in general, the default strategies in wealth creation have been fairly high up. So from a trustee choice point of view, I think that that does pretty well. If you look at the moderate and conservative portfolios, I think focusing on the 3 and 5 years, your SMM Moderate Absolute and SMM 50 and SMM 30 have sort of done fairly well over that time period, with beating the cash product. Over the last sort of 12 months, it's been cash that's done the best. High interest rate environment, bond yields pushing up. As you saw on the market slide at the beginning, if you have a lot of bonds or fixed interest over the last 12 months, you wouldn't have done that well. And a lot of these more conservative portfolios do have more bonds in, so you can't expect them to perform as well as some of the other funds when bond yields are pushing up. So that's why cash has done well. But over the long term, you expect these funds to deliver better than cash returns, and that's exactly what they've done. So thanks very much for your time today. That's me. I think I'll hand over to Donnie now.
Thank you, Paul. Good morning, everybody. Now, as Paul mentioned, we have in our default the 4 lifestyle strategies, and then we also have the 3 protection strategies. Now, I'll take you through the 3 protection strategies. The first one is Sanlam Secure. That's our most conservative one with the strongest guarantee. Then the Sanlam Stable strategy. And then the volatility protection strategy combines a smooth bonus portfolio with a passive aggressive portfolio. The whole idea is that passive portfolio can give additional returns when markets are running and doing very well. But it also means that the volatility protection strategy does not provide a capital guarantee. In times, it can have a negative return over a certain month due to that passive component. Now, if we just look at the returns over the last while, I have that the volatility protection strategy has done quite well, especially the 3 years and 5 years. Sanlam Secure, the more conservative one, you'll see it's a bit lower than the others because it's the most conservative portfolio with the highest guarantee fee and the strongest guarantee. So that's really there for people very close to retirement. I don't necessarily think that people should be invested in a secure strategy for like a 30, 40-year period. It's a very conservative portfolio. Sanlam Stable, also done well. The last year, 10.4% for more conservative portfolios is quite well. And I think the main message I want to get there is all these portfolios have comfortably outperformed inflation over 1, 3, 5, and 10 years. If you look at the 10-year number, you can see all of them have outperformed inflation with more than 3%. That's gross fees. and they're really giving comfort to members who don't want to see that volatility. And I think that's the more important thing. The protection strategies are there for your more blue collar risk profile membership, where members don't want to see big jumps and falls in their asset value from month to month, and specifically not from one benefit statement to the next benefit statement. Now, as I said, these portfolios are there to provide stability and security. The one way we provide it is through the monthly bonuses to be declared, and we try and smooth investment returns over a 24-month period. But also the other way we manage it is just through our asset allocation. Now, I'm focusing here on the stable strategy. You'll notice that this is a moderate fund underlying. So if you add all the equity together, local and offshore, you get to 50% most of the time. Very different from the accumulation portfolios that Paul referenced earlier. There, the total equity is sitting at 70%. So a very different kind of portfolio. You'll notice also in these kind of portfolios, we do like a bit more inflation-linked bonds because it's often used for people close to retirement. So a very different structure. If I add up all international, you get about 30% international assets. The portfolio manager can go up to 35%, but this is not a type of portfolio, or these portfolios are not going to be the ones we have 40-45% invested offshore. So very important, you just keep it in the back of your head that these portfolios have a more moderate profile, and therefore you'll see less equity than accumulation or wealth creation, also a bit less international assets. Turning to the preservation phase in our life stage solution that Paul touched on, it's also important to realize that the preservation phase is also invested in the smooth bonus portfolio. In this case, a stable bonus portfolio. So we use it for options on the protection side pre-retirement, but then also all for the life stage strategies end up in the capital protection portfolio, which is a smooth bonus portfolio for the last couple of years before retirement. Members start getting switched into that over 15 monthly switches, and they end up in this portfolio for the last 100% for the last 22 months. Now, as I said, this is in the same performance we saw for the stable strategy. Once again, outperforming inflation quite handsomely. In the bottom there, I just subtracted inflation from the gross returns. You can see over 1 year exceeded inflation by 5.1%. 3 and 5 years a bit lower. I think Paul has highlighted, the lower equity returns over a 3 and 5 year period. But over a 10-year period, members would have received inflation plus 3.7, which I think is quite handsome for a more conservative type product that provides smoothing and guarantees. Also, just very important, when we look at these portfolios, we try and tell clients that we want to be as boring as possible, not provide any surprises for any of our members. And you can look there in the Sanlam's a blue line versus our main competitors. And I think over some very trying markets, we had the COVID crash in 2020 in the middle of the graph, members were not exposed to any big surprises, either to the up or downside. And this is exactly what we want to see for a portfolio that's used for members very close to the retirement date. You don't want to see a negative return. You don't want to see extended periods of zero bonuses. And I think we've really achieved that, what we set out to achieve over all this very difficult period. So if I can just bring it all together, we like using the capital protection portfolio for members close to retirement. It still provides members with diversified exposure to all the asset classes, but you provide a smoothing and guarantee so members don't have that shocks before retirement. And the last thing you want to do is have a significant negative return. Here I just have two examples, Solly and Donnie. Where Solly is invested in a smooth bonus portfolio or in an average balance fund, he's still okay. But then you get to poor old Donnie in this example, he retires a few months later, and suddenly his retirement fund value is significantly lower. And most South Africans' retirement plans are not robust enough to survive a kind of shock like this, especially not if they're going to buy a guaranteed annuity. So this is why we think it's very important when members are the most vulnerable, when they have the biggest pot of money saved up, they need the smoothing and the guarantees provided by a capital protection portfolio so that they don't have that shock and can still retire with comfort. And we'll see that throughout all our lifestyle solutions. We use this, and we use the same methodology because we think it's important for all these members close to retirement. So I've wiggled through my section, and I'll hand over to Nzwa. We'll just do a quick wrap up for us, and thank everybody.
Thank you, Donnie. Yeah, I guess a good place to start for me is good morning, everyone, and thanks for joining us. think from my side, it really is just a simple thank you. I think to all our intermediaries, the participating employers, as well as the members, who are partners in financial confidence. We've been having various discussions with you guys over the years, and we'd just like to thank you for the incredible support of the Sanlam Umbrella Fund, which you've obviously put your trust in for all your members as well as your participating employers. I guess on behalf of Sanlam Corporate, we're grateful for the ongoing support, which has ensured that we remain the fastest growing umbrella fund in the industry. And you'll see from the slide that you've got in front of you at the moment that we've managed to double our assets under management in the past 3 years. And despite some of the challenges that we face in our industry, as well as some of the challenges that we face within our business, administration is not an easy game to be in, especially in the retirement fund space. I think, from our side, we are even more dedicated and committed to being a partner in all aspects where value, service, and quality go hand in hand. So on behalf of Sanlam Corporate, I can assure you that you've got our deepest gratitude, respect, and appreciation. And we do look forward to reaching even bigger milestones in the future. I think 150 billion is probably the next milestone for us. If I look at what's been presented today by Danny and Paul, it seems that markets did rally in May, so hopefully we'll see some good growth on the umbrella fund side. So lastly, once again, from our side, is a big thank you. If I could also just kindly ask you to complete the poll that will come up on your screens, and chat soon. See you guys in our next session. Goodbye, take care, and enjoy the rest of your day.